Good afternoon, everyone. We are thrilled to be here today presenting to you our investment recommendation on Galp, the leading Portuguese integrated oil company. My name is Margarida and these are my colleagues, Arthur, Patricia, Jorge and Cesar. We issue an updated buy recommendation with a price target of 12.1 euros per share. This represents a 26% upside potential from the March 9 closing price. Our recommendation is based on three long-term pillars. First, the strong outlook for oil and gas demand in the upcoming years. Second, Galp's strategic positioning throughout the oil and gas value chain. And third, the company's sustainability for the future. We updated our forecast in order to take into account all the recent events in the financial markets. We'll start with a brief overview of the business and discuss our three pillars. Then, we will drive you through updated valuation and finally present investment risks.
You may be asking how fossil fuels become part of our everyday life. Everything starts in the upstream, which covers all activities of searching, recovering, and producing crude oil and natural gas. These raw materials are then transported by the midstream to the downstream. Here, they will be refined, and the resulting byproducts will be marketed and distributed, making them available for everyday use. So, where can we find Galp? As an integrated oil company, Galp's presence can be felt throughout the whole chain, in the upstream, with the exploration and production segment, and the downstream through the refining and marketing and gas and power segments. The R&M segment is the main contributor to the company's sales. However, the E&P segment will be the one adding the most to the company's EBITDA and value. In the short and medium term, the healthiness of the company will be heavily linked with the outlook for oil and gas demand. There is this general idea that electricity will take over oil as a main energy source. However, we believe that's not the case. A strong oil and gas demand is expected to be maintained as the world economy is highly dependent on fossil fuels and their byproducts. Expectations point out that by 2040, oil will still lead the global energy mix with a 28% share. And so how does this outlook affect Galp? Well, the supply and demand of oil had a strong influence over oil prices, Galp's main driver of profitability. However, crude prices can also be affected by other variables such as economic shocks, geopolitical conflicts, and like now, a virus outbreak. All this leads to high volatility, and due to that, we updated our forecast, and our range for the Brent price is now between $43 and $60. This strong outlook gives a solid foundation over which Galp will keep implementing its strategy. So let us move on to the second pillar, strategic positioning of the company. In the upstream, companies operating partnerships. Galp has stakes in two of the largest projects ever for oil, in the Lula field in Brazil, and for natural gas in the Rovuma Basin in Mozambique. The company has a total production of 120,000 barrels of oil equivalent per day, with the projects in Brazil representing around 92% of that figure. This makes Galp the third largest producer in the country. We believe that these projects will be the main driver of a 10.8% CAGR in production until 2025, almost doubling 2019's figure. We expect that the increase in production, aligned with forecasted oil prices, will lead to twice the amount of sales. The E&P will still benefit from the low production costs associated with the Brazilian pre-salt projects, making the segment the biggest contributor to Galp's EBITDA. Now, Patricia, can you drive us to the downstream?
Sure. The R&M segment is in a stable and mature market. In refining, Galp currently controls 20% of the Iberian capacity, being the only player in Portugal. In marketing, its position as retail's market leader in Portugal gives the company a slight edge over its competitors. In the last couple of years, Galp's refineries have been through maintenance operations in order to increase their efficiency. With the end of those operations, we anticipate the segment to recover and eventually improve its performance. R&M's profitability will mainly come from the refining margin, which we expect to average $6.1 per barrel of oil equivalent. With this increase, we believe its EBITDA will grow at 2.3% CAGR. The G&P segment stands as Galp's stepping stone into energy transition. We expect its capex to triple by 2025, with most of it being invested in solar power generation. We believe that this, aligned with the expected increase in demand of natural gas and electricity in Iberia, will lead to the 2.5% CAGR of the segment's EBITDA. We consider that this investment marks Galp's commitment towards a sustainable future, which brings us to the third pillar. We believe that Galp's plan is to move from an integrated oil company to an integrated energy company. Part of that is linked to ESG, in which the company is very focused. For example, Galp ranks first in the Dow Jones Sustainability Index for European oil and gas companies. Furthermore, social responsibility is also in the company's DNA, as it develops several social products in the communities where the company operates. Now, Margarida, talk to us about sustainability.
Yes. We believe that the current focus in oil exploration will give place to a more balanced mix between oil and gas. The main responsible will be the Rovuma LNG, which is expected to begin production in 2025. This project will facilitate the increase of natural gas from 12 to 30% in the production mix by 2030. In the long run, we expect Galp to focus its operations around electricity and renewables. This change is already in motion, as the company is the leader in car charging points and is working on its first hydrogen station in Portugal. The company is not only operationally sustainable, but also financially sustainable. Galp has set itself to a net debt to EBITDA maximum of 2, currently having 1.2. These values are in line with what its peers present despite their higher leverage. Figures do not lie when it comes to showing how Galp is sustainably managing debt. We strongly believe that the solid operational performance from all the segments will lead to a strong cash flow generation. We estimate that the free cash flow to the firm will grow at a 20% CAGR from 2019 to 2025, mainly due to the increase in the free cash flow to the firm from the E&P segments.
Thank you, Margarida. The previous 2 points will allow the company to be sustainable for its shareholders. We forecasted a 10% year-over-year increase of its dividends until 2021, reaching more than €1 by 2025. The high levels of liquidity should also allow Galp to efficiently manage their working capital, presenting a current ratio between 1.7 and 1.8 in the upcoming years. So, since our assumptions are set, let's talk numbers. In our base case, we valued the company with a sum of parts approach, reaching a target price of €18.1. However, the COVID-19 outbreak is affecting everything around us, and Galp is not an exception. So, we adjusted our forecast to capture the current landscape. Due to the expected decrease in energy demand, we lowered Galp's production and adjusted the oil prices throughout the forecast. We reached an updated price target of €12.1 per share, representing an upside of 26%. The biggest contributor for this price target will be the E&P segment, representing 68% of the enterprise value. The purpose of using the sum of parts valuation is to capture the different risks in each segment. We estimated a clearly superior WACC for the E&P, as its operations will yield a bigger risk. The downstream segments will have a smaller WACC, catching the favorable positioning of the company and the smaller risk of the sectors. Additionally, we considered that the Rovuma LNG project wasn't fully captured in our sum of parts valuation, as first gas is in 2025. Through a comparable transaction approach, we valued Galp's stake at €1.05 per share. So, Jorge, what about the other methods?
Well, Cesar, to complement our analysis, we also use the free cash flow to the firm for the company as a whole, the free cash flow to equity, and the adjusted present value. Independently of the method used, we reach price targets that further support our updated by recommendation. Finally, we assess the company's value through multiples. Our final peer group consists of European IOCs. Galp is trading at a premium when comparing to its peers, as the market believes the company still has capacity to grow. The price target obtained will not capture that potential growth and will therefore yield a lower value than the remaining methods. As expected, an investment in Galp will be exposed to some risks. Commodity prices are an unavoidable risk for oil and gas companies. As previously mentioned by Arthur, the prices can be affected by a wide range of exogenous variables. Nonetheless, its impact in Galp's value will be limited by the natural hedging. We stress this variable reaching a buy recommendation in 54% of the scenarios. In our first presentation, we defined the blue and the gray sky scenario. In the blue scenario, we increased oil prices and exchange rates, along with a more optimistic operational outlook. In the gray scenario, we assume the reverse situation. This set the price floor of €11.3 and the price ceiling of 21.3. Recent events led our updated valuation to be slightly superior to this price floor.
Wrapping up, due to a strong energy demand outlook, the company is strategically positioned to keep growing in the years to come, driven by its increasing production and diverse portfolio in both location and operation. That sets the base for a sustainable growth, both financial and environmentally, in the short, medium, and long term. With all this in mind, we recommend you to buy Galp's shares and join us, extracting profits from the current mispricing. Thank you for your attention. From Portugal to the world, we now open the floor to questions.
Thank you for the presentation. If I may start, one thing that concerns me a bit is your oil price assumptions. I have looked at the slide number slide number 6, which shows a chart of Brent price oil forecast, which is okay, it's below 60, I think, starting from 50, and then it goes up to 50 something, close to 60. And I believe that in one of your slides you had a forecast of 60. At least it looked like it was straight away. Am I correct?
I can take this one, guys. So what we have is we adjusted our forecast due to recent events. So we start at 43, and our source is the American EIA. And then that grows over the years up to $60. So the 60 is for the terminal value.
So 60 is when in your assumptions? Oh,
2025.
2025. Okay. Okay. Me again. Okay. Let it be. It seems that in your DCF model you have used a 5-year forecast instead of 10-year forecast. Could you explain why is that? I'm not saying it's wrong, but it's the typical forecast period is 10 years, right?
Yeah, I can take this one as well. So when we started forecasting and when we started reading through the company and the industry, one of the things that we found out to be more difficult is how to deal with commodity prices. Specifically for us was oil. So the further down the line that we start to try to forecast, the harder it is to have a more accurate forecast due to the oil price forecasting. So we use from where we could get numbers and sources, and then we have sources like the International Energy Agency, we have OPEC, we have McKinsey, and due to that we decided, okay, let's do a forecast that will give an accurate picture that, and also that will give us an interesting range for our valuation. I don't know if Cesar, you want to comment?
Yeah. Additionally, when we researched the industry, we saw that the cycle of the companies in this industry was between 6 and 7 years. So we found, additionally, due to what my colleague just previously said, we thought that the 5-year period would be enough. Yeah.
On this year, I think it's quite interesting to split the activity in 3 different parts. Can you elaborate on how did you compute the risk premium for each division?
Josh?
Yeah, so for the market risk premium, we went to a source, the Fernandez et al. We use that source and do, yeah, that's it.
Yeah. If I may add, we, dependent of the segment that we were using, we use market risks that will be different. So in the refining and marketing segment and GNP segment, since most of the operations are in Portugal, we use the market risk premium of Portugal. In the ENP segment, since most of the risk comes from operations in Brazil, we use the market risk premium from Brazil.
Mm-hmm. Okay, and what about the market risk premium and then the equity risk premium for each department or each activities? You have different figures.
Yeah, exactly. Different figures because different risks of each segment.
Yes. Can you come back to the slide where you show the different risk premium and now the other one depending on each activities.
Oh, okay.
Which was quite interesting. Yes, this one I think, yeah.
This one. This one?
Yes. So the cost of equity that you use depends on the market risk, not on each department risk. Is that correct?
It depends on the market risks, and it also depends on the beta of each segment. since the peers would be different, since they are different sectors, we would have different cost of equity because of that.
Okay, thank you.
Thank you for the question.
I also have a question, but in regarding the capital structure. You said in one slide that capital was going to triple during the forecast period, correct?
Yes.
However, I am wondering if you use the same composition of debt of 20% and equity of 80% that you're showing us on slide 22. So you're okay.
Sorry. Okay, so I can take this one. Yes, we kept the same capital structure throughout our forecast. However, if the company needs to raise debt to finance some of their projects, they can do it easily because, like my colleague said, Galp's net debt over EBITDA is currently at 0.9, so they can easily fund themselves as well.
Okay, can I ask an additional question? Which is the long-term growth rate that you're using?
I can take this one. Yeah, so since we do sum of parts valuation, we have terminal growth rates that will be different depending on the segments, ranging from 1.7 in the operations in Portugal until 2.75 in the E&P segment. The thing is, since they are different, if we are looking at the company as a whole, the weighted average will be more or less 2%.
If I may jump into, what's the percentage of your valuation that comes from terminal value and from the forecasted cash flows? What's the split?
It will be, George, can you show us another slide, please?
Which one?
From the beginning, I think. Or, for example, yeah. No. Yeah, actually, I don't recall if we have that, but it will be probably 60%, 40%, 40% for the forecast and 60% for the terminal value.
Okay. So in 5 years, it's 40%, and the terminal value is 60%, roughly, right?
Yeah, yeah. If I recall it correctly, yeah, I think so.
Okay.
I'll ask a question, if I may. One of the big issues on the oil market recently has not been coronavirus, but Saudi Arabia. Could you comment, please, how you capture or factor in the risk of Galp being a price taker in this market and the kind of unpredictability of Saudi, and how does their cost of production compare? What is their exposure in a world where OPEC is no longer really functioning? And how have you considered that in your analysis?
I can start on this one. So what we did was when we updated our forecast, one of the things that we did, we looked at oil prices and we also looked at demand. And indeed, that is one of the things that are shaking the market right now. But on our point of view, what we do is what we know that Galp has a very low break-even. So the break-even is below $25. And what we also know is that on a world economy point of view, to have the prices this low, it's not doable. What happened in the past few years, and we have a slide for that, George, if you can pull that up of the charts of the oil prices. What we saw is that the prices would go low for some reason due to crisis or moments, and then they would go back up again. So, and we were also took into account the demand, and also the demand that was affected due to the COVID-19 and onwards. Cesar, do you want to add?
Yeah, actually, the two outlooks that we used in our research from McKinsey and from the EIA, they both took into account the current landscape of the OPEC trying to change the way that they are in the market. So Saudi Arabia and Russia trying to search for market share. So they took that into account, and they always show us a forecast between $50 and $60 for the medium to short to medium term.
Time is up. Thank you.
Yeah.